Let's connect with Sean Darby, head of equity strategies with Jefferies. He joins us live from Hong Kong. Sean, morning. Thank you for joining us. First, characterize the global environment for us. Now, there is no mystery in why global money managers are in a risk-off mode. Do you think at these levels, global money managers are pricing in a disorderly exit of Greece from EU?
That's a very good question. I think the bond markets have certainly priced in both growth downside and probably an aftermath in which Greece does leave the euro and the repercussions for European growth. So the bond markets have done a lot of the work since mid-March in pricing in a pretty bleak economic landscape. For equity markets, I think there's been initially a great deal of denial about what's been happening in Europe. And the fact that we haven't seen necessarily the same contagion in terms of credit spread moves until very recently, or indeed underlying FX moves, has perhaps meant that equities were very late in pricing in this, in the chances of a disorderly exit for Greece. I think the bottom line for us is that valuations on these points in times don't necessarily tell you about the degree of panic that is building up in the markets. And I think right now it's very much people are preferring to sell and wait, or indeed hold on to positions rather than looking to actually acquire companies or trying to pick the bottom of the equity market.
Sean, hi, morning. Back in February, you'd advised selling into the rally that equity markets in India at least were staging. There's been a big reversal ever since then, and you were pretty right saying that it would not last in the second quarter of the calendar year. How much more downside in Indian equities before we see a significant pickup?
Well, thank you for remembering that call. The two things I think which have started to become apparent in Asia, and first of all is really what is the US dollar returns. And what we're seeing through Australia, India, and to some extent some of the other countries with high local interest rates, is that there's also been an unwinding of some of these carry trades. And I think India is included in that. So I think from international investors, they're still now becoming preoccupied about total dollar returns. So you may look at your local market and think there's maybe 5 to 10% downside. A lot of the foreigners are looking at maybe 15 or 18% in dollarized, in a dollarized basis. I think the second thing is this, and that is that the markets will probably price in proactive policy stances. So to some extent India has been ahead of the curve in actually relaxing monetary policy and trying at least to start to create some catalysts for the economy. And then I guess the downside risks in the short term for India are probably less compared to some of the other markets like in Europe, which are very policy dependent and where policymakers have been on the back foot.
So what are FIIs doing at this point when it comes to Indian equities? Are they liquidating their positions, sitting on cash, or do you think they're buying into the fall?
Well, I think there's two preoccupied sort of motives for the FIIs. The ones who are who need to be invested in India are probably are doing enormous amounts of rotation, and I think the currency adjustment is one that's probably on the uppermost in their minds. The second is this sort of nagging fear that if oil prices don't retreat sharply, the chances maybe of a growing of a balance of payments problem in India. So I think the irony is at the moment is that there's not been massive withdrawals from the actual funds. I think FIIs are holding on to quite large cash positions. They were basically fully invested at the end of March from what we can see. So right now these FIIs are holding on to cash and doing very little. But it's the moves in the rupee which are probably preoccupying them at the moment, and that really is where where they are sort of looking at as a potential level to get into the market.
Sean, but the only silver lining for a market like India is that commodity prices have also collapsed, and India happens to be a net importer of oil, copper and other basic commodities. So do you think that once the dust settles down, the fear trade recedes, Indian markets could start outperforming?
Well, that's very true. I think the one thing that we were worried about in first quarter was that any potential paralysis from higher commodity prices, and certainly for India and for Turkey, that was the two concerns that we had. I think and really that's very much driven by the fact of concerning the dollar. So I think the bottom line is this: if the dollar were to strengthen very sharply, it would ultimately still be quite negative for emerging markets in India, because people would look at that dollarized return as being very much what would be driving their investment. In the short term, if you had a reasonable unwinding of the commodity trade without necessarily the dollar rallying, that would be very, very good news for India and emerging markets in general. That would be a nice reflation in that the global investors were not fearful of a very sharp loss of currency returns, and the fact that the inflation fears and balance of payments fears in EM were being reduced.
So, Sean, given the way how things have evolved in Europe, US economic data of late has been mixed, and China is now threatening to slow down further. Do you expect US Fed to announce QE3? Because in their last communication, they made it very clear that they want to keep the quantitative easing window open.
Well, I think the key to the QE is that the data points would need to deteriorate for the Fed to have the excuse to act. And I think whilst they keep the ammunition of QE in the background, necessarily deploying it very early may be a mistake. And politically, coming into the US presidential election may actually be higher. So I think the way to read the federal policy, unless you see a very sharp deterioration in Fed data and or that the contagion was spreading into the US, I think the Fed would prefer to wait for a combined intervention and combined global monetary solution to anything that happens in Europe, rather than being unilateral in its actions.
Sean, I just have 20 seconds before I lose the satellite link. What is your India call? Are you neutral? Are you underweight? Are you overweight?
We are still bearish in the short term, and I think, as you pointed out, the crude oil price and the dollar move is really what will change international opinion on Indian equities. But I would think, if all things being equal and we don't have a big unwinding in Europe, then about third quarter looks actually pretty opportunistic to get back into India.